This is the One Point Podcast, and I'm Rohit Yadav. Today, we are covering the strategic venture asset class from a fund of fund angle. And to do this, I have a venture industry's well known figure, David Clark from VenCap, with me. David is the CIO of VenCap, a fund of fund that has committed massive 2.9 billion to more than 450 venture capital funds across the US, Europe, China, and India. And David has decades of experience and an unparalleled knowledge of the venture ecosystem. So he's known by all of us and publishes his extremely insightful nuggets on LinkedIn, openly on the social media about the ecosystem, and his recent white paper on how to build a VC investment program and why past performance is the best guide to the future performance is a must read. So I highly encourage everyone to go and read that. David, thanks for joining in.
No, Rohit, pleasure to be here, and you're very kind. Thank you.
I'll just dig right in. So, from a fund of fund allocation perspective, one of the topics that's not covered intensively is how do you decide to allocate to funds on a strategic perspective? So, what's your angle? What's your, let's say, due diligence strategic angle to viewing each and every venture manager? Is it just the investment performance from the past, or are you also looking at secondary aspects, which could be geography, which could be stage of a venture fund, and so on?
Yeah, I think as an investor, you have to go back to first principles. And so the very first question I think you have to ask yourself is, what is it that we're trying to achieve through our investment in venture capital funds? And if you look at the historical data, one thing, we like at VenCap is data, because I think it really informs everything we do. So we'll be referencing a lot of different data points, I'm sure, as part of this conversation. But if you go back to the performance data on venture, it's very clear that the average venture fund isn't something that you want to invest in, and so median returns in venture are on average about a 1.7x TVPI and a 9% IRR. You're not doing venture for that. So I think, for us, what we're trying to achieve is to get up to that upper quartile benchmark. And then you're looking at, 2.5x sort of multiples and high teens, 20% IRRs. So that's the standard that we would hold ourselves to. We want to be consistently hitting and beating that upper quartile benchmark. So with that in mind, you then need to ask yourself, well, how do I construct an investment program and an investment strategy that allows me to do that in the most efficient way possible? And obviously, there's lots of different ways that you can approach the venture industry. Clearly, if you're following things on LinkedIn and Twitter, there are a lot of people there pushing the smaller is better, emerging managers are better. What we found there is that, definitely the very best fund in any particular vintage is probably going to be a $10 million pre-seed fund from an emerging manager. But as an LP, my ability to identify and select that fund consistently is virtually zero. So I think you have to really bring in that, yes, a lot of these things sound good in theory, but we play the game on grass. It's a bit like, sounds good on principle, we play on grass. Now, how can you execute something consistently? And so what we found is that the best way for us to achieve those top quartile performance consistently is to really focus on those managers that are able to back those top 1% companies fund after fund after fund, and do it in a way where one single investment returns the fund. So we don't think about the VC industry by geography, by sector, a little bit by stage, and we can touch on that going forward as to why stage is a little bit different for us. Okay. But really what we're trying to do is identify the very best managers and back them consistently, and not then try and overcomplicate things. So for us, it's really about, as a manager, if you're coming to us, the first thing we look at is how many of these top 1% companies have you backed historically, and how have they moved the needle at your fund level? And what we found is the more times that you're able to generate fund returning outcomes from backing these top 1% companies, the higher the likelihood you're going to do that going forward. So that's our framework. Okay. But it absolutely comes back to, it's because we're not trying to pick the very best fund in any particular vintage. We're trying to deliver consistent top quartile returns to our investors.
Okay. So Your focus is extremely on the performance, past performance, as I mentioned earlier. When we talk about funds in the US versus China versus India, and you're invested in multiple geographies, right? How did you come about investing in those? So, did the managers then approach you? And is your then angle of we invest only the managers that approach us, or do you reach out to the managers that you believe are top quartile or investing in the top 1% of the companies?
Yeah, so I'm struggling to remember the last time we invested in a manager that approached us directly.
Okay.
Um, I, I,
Okay.
I'm not. I don't think we've done that in the last 20 years.
Wow.
And
Okay.
and so the way we think about it is, I guess there's two parts to answering your question. So in terms of how do we identify managers today, it's very simple. We look at who's been backing the top 1% companies, and that gives us a list of 30 to 40 managers
Mhm.
that have been able to do that consistently. We then know that a number of those are investing more later stage and they're not able to generate fund returning outcomes from that particular investment. So a good example of that would be, Insight with Wiz. Wiz
Yeah.
was acquired for 32 billion, or is about to be acquired, hopefully, for $32 billion. Insight owned about 10% of that. A great return for them, returning $3 billion, but their last fund was 10. So that's not a fund returning outcome for them. So that's not something that we would want to pursue, because one of the things we found, and we've shared this data, and it's similar to what other people have shared as well, is for us 90% of certainly early stage funds that return 3x net have at least one company that returns the entire fund. So that's why backing the top 1% companies, but being able to return the fund from those investments is super important. So we essentially have a screen that
Mhm.
throws up a list of 30 to 40 names. So we're invested in, 10 to 12 of those managers. So those come off. We know there's another 10 to 12 that are probably too large to be generating those fund returning outcomes. So SoftBank would be on there, Insight would be on there, Tiger would be on there. That's not something that we would be looking to pursue. And so that probably leaves us another sort of 10 to 15 names that would be our kind of target. Now, of those, there are some managers that we know we're just not going to be able to access.
Okay.
And so, ultimately we get down to maybe 5 to 10 managers that are actually, realistic targets for us to go and try and build relationships with.
Okay.
And then there'll be some managers that are kind of just beginning to emerge onto that screen, and so we'll start to develop relationships with them to see how they may be on a fund 2 or a fund 3 or a fund 4. So we'll develop some relationships there as well. But essentially, we are identifying who we think are going to be consistently backing those top 1% companies, and we will reach out to them and try and build those relationships. In terms of how we did it for China and India, it wasn't us saying, oh, we think China's going to be the next great market, or we think India's going
Okay.
to be the next great market. We have a view there, but I think we recognize as LPs, we're not the best people to take that macro view. We're not macroeconomists. We're not global strategists.
Got
We
it.
think we're quite good at picking venture funds. So basically what we did there, we had a couple of our managers who said, we're going to start to invest in these regions. We're either going to build a team ourselves or we're going to partner with a local group. And we essentially followed those managers into that geography, invested in a couple of funds, started to build up our expertise of the manager environment within those areas, and then may have then gone and picked up one or two local managers as well out of there. But
Okay.
in China, we back 3 managers, and they're all kind of, certainly historically have been linked to US firms.
Got it.
Same in India, 3 managers, all historically linked to US firms.
Got it. So it's about the managers who probably are formed outside and they are exploring the regional economies, maybe India, China, and Asia, and so on. You hinted on one aspect of early stage versus late stage, and you said we can talk about it later. So now is the time we talk about it.
Yeah, so the one thing we do, so geography we don't really try and manage. Sectors we don't think
Okay.
that we have any real input. The only thing there is, we want to make sure we can sleep at night. So if all of a sudden our portfolio was 50% China, that would make me really nervous. So we manage our risk a little bit around that, but essentially it's ultimately backing the managers and where they find the opportunities. The stage is a little bit different, and it comes back to, I think, one of the challenges that we see with the venture industry. So as you know, venture takes a long time. The common joke is the average venture fund lasts longer than the average US marriage.
US
And I
marriage.
think it's actually twice as long because the average US marriage is about 8 years these days. And I'm sure the average venture fund is at least 15, 16 years. And particularly for early stage funds, it takes time for companies to mature and reach scale and ultimately exit. Wiz again was a complete anomaly. The largest venture-backed M&A, hopefully
Yeah.
the largest venture-backed M&A exits that we've seen from a company that's only 5 years old. That's an absolute anomaly. Normally, you're looking at companies being 10, 11, 12 years old before they're really able to reach that kind of scale and generate liquidity at that level. So what that means is for your average venture fund, it's going to take 10 years before you're seeing material liquidity coming back from early stage. So for a lot of investors, that duration is just too long. They need to find ways to try and get some money coming back a little bit earlier. So we do actively manage around our early to growth relationship, and we want to try and be roughly equally split between early stage and growth. So around sort of 50% early, around 50% growth, give or take a little bit. We're happy if it's 45, 55. And then we'll also add a little bit of secondary investment on top of that as well. Again, to shorten the J curve, to reduce the duration, to try and get some capital back a little bit earlier. What we don't want is, and we think this is a really bad thing for LPs to do, is to press their early stage funds to sell their best companies prematurely. It's so hard to get one of these top 1% companies. If you have one, then you want to ride it and you want to maximize the impact on your fund of successfully investing into that company. As I say, the worst thing you can do is to sell it prematurely. So we encourage our managers to ride their winners as long as they think it's appropriate. They're the best people to judge when the right time to sell is. And we'll manage the duration of the portfolio through the mix of early and growth and secondaries.
Got it. I think the last part that you mentioned of managing the duration, it's key point that a lot of LPs need to understand that there is a way that you can manage via early stage and late stage investments, and diversifying these stages, you can still have your liquidity pool and the duration matched and so on.
Yeah. So what we've seen just on that one, typically we would make our first distribution back to our LPs in about year 4, and that's partly because of the liquidity that's come through the secondaries, partly because of hopefully some liquidity that's come through the growth funds. By about year 8, year 9, we should be 1x DPI. And then you start to see DPI, really accelerate in those later years as companies mature and go public. And it does vary, fund by fund, depending on when that IPO window really opens. So, it's plus or minus year 8, year 9 for the 1x DPI. If we have a slightly earlier liquidity window where things are able to go out a little bit earlier, then clearly that's going to pull the liquidity forward a little bit. In the market today, that liquidity is getting pushed out a little bit further.
Yeah, got it. And I think for LPs, it's very important because when you consistently invest in venture across the time span, across the years, then you see what VenCap is delivering right now, which is, I don't want to use the word consistent because venture is not consistent, anything but consistent, but still this nice layer of DPIs get generated because of the past funds and how you can share the portfolio yourself. Amazing to hear the stuff. Viz was part of your portfolio. So
We had some
congratulations on
exposure
that.
to it, thankfully, yes.
Yeah, congratulations on that. The name came up a couple of times, so I got the connection over there. I want to touch the next question on alpha, and I want to touch base on the points that you mentioned multiple times, which is relationship driven uh, attitude towards VC fund managers and forming those relationships very early on, and like working along with those relationships for not 5 or 6 years, but maybe more than a decade or so, right? So there's this term called as relationship alpha within the industry, which says you have those relationships, you build those access systems to those specific VC firms, which VenCap has done. Do you think there's any other way to win in this venture ecosystem? for other FOFs, for example?
Yeah, I mean, I think there are different ways to play it. I want to come back to this concept of alpha, because I think it's a really, within the public markets, the concepts of alpha and beta I think are quite well understood, and people just throw those terms about loosely into other asset classes. I
Mhm.
think particularly for venture, it becomes much more nuanced. So if you look, venture's a power law asset class. We know that it's 60% of deals don't return capital, and it's 5% of deals that kind of represent the bulk of the value that's created. And if you look at exits, 1% of companies generate 52% of exit value. So it's a really concentrated asset class in terms of who generates the value, and that's also true at the fund level. So, there's a big gap between the median fund return and the aggregate industry return. And that's because there's a small group of outlying performers at the fund level that drag the aggregate up and obviously don't impact the median. So when you're thinking about the concepts of alpha, and stop me if this is getting too technical, Rohit. Again, it's a bit of a kind of inside baseball sort of thinking here, but it's
Technical is good.
cool,
Let's
good.
say
I'm
technical
not
is
sure
good.
about your audience, so I'll let you stop me if we're going too much. But yeah, I think the idea of alpha and beta within venture is a really interesting one, because you could argue beta, the market return, is actually the upper quartile return. So if you look at the aggregate industry return, it's much closer to the upper quartile than it is to the median. And so when you then start using terms like alpha, you're really then looking at the top, I don't know, top 10%, top decile, and trying to consistently pick top decile funds, I think is impossible for an LP. So it goes back to the very first question, which is like, what are you trying to achieve from your venture program? For us, it's about hitting that top quartile return, which is actually roughly the aggregate return, or beta. So in venture, I'm really happy capturing the beta without thinking I've got to consistently chase after the alpha, because I think what that does, it then starts to layer in an additional level of risk, which ultimately pulls your performance down. And so the more you chase alpha, the less likely I think you are to achieve it in venture, because of the power law nature of the asset class and the fact that there is a consistent group of managers that are backing those very best companies. So going back to your question around, are there other ways to be successful of a fund of
Yeah.
funds? I think there are, but I think you're taking on additional levels of risk. And I think when we look at you, so you either have to be exceptionally good or you have to be lucky. And I think for most LPs, you have to recognize that you don't want to be basing your investment strategy on getting lucky. First of all, I think if you do get lucky, great, but that shouldn't be the foundation of it. And then I think a lot of LPs, I would argue, overestimate their ability to select managers based on factors such as the quality of the team, or their strategy, or their process, or the way they make decisions, or the quality of their network. We've found that those things are not great predictors for whether a manager is going to be successful. So one particular family office who says, we're only going to invest in emerging managers in small funds, but we're going to do it in a way that tries to index that market. And by doing that, we'll achieve the beta of that market, which is the upper quartile, and we're happy with that. And I think that is a much more intellectually honest way of thinking about how can I be successful in the venture industry, than saying, actually, I as an LP have the ability to select which managers are going to be successful and which aren't.
Okay, so let me just pinpoint on this one point. The family office which said we want to index. What do you mean by index? If you can explain that.
Yeah, so they would say there's maybe 2,000 companies over a 3-year period that are funded at the seed level. They want to back managers that give them exposure to enough of those 2,000 companies that there's a 95% confidence level that they will get an aggregate market return from those companies. And so the way they go about it is actually looking at finding managers that don't overlap in terms of their portfolio. So
Okay.
they're looking for discrete sort of areas of that. So a manager needs to be giving them exposure to a discrete part of the market, and they don't want another manager that overlaps on top of that. So they think that by getting that enough of those managers and getting enough exposure, that they're giving themselves a really high probability of getting that market return, which is the upper quartile return.
Okay, so let me go one level down, a bit more technical. So when they say they want to capture just one area with one manager, then there's a selection, I wouldn't say issue, but like selection criteria involved, right? How do they then select this one manager, and how do they then believe that this manager will deliver the top top thing within that segment?
Yeah, look, happy to introduce you, to them. They've
Okay.
done a few podcasts and are also active on LinkedIn. So they're probably in a much better position, I
Okay.
think, to explain that strategy than I am, because they're living and breathing it. But I think that they're really looking at what are the networks, where are those managers focusing, and making sure that each investment they make is in a discrete part of the market.
Okay. So I want to like continue within this conversation and talk about the size of the industry. So VenCap is 3 billion in committed capital, right? But there are much more need of capital allocation for the venture funds in general, right? And if we take aside this topic of alpha, beta, and how the selection is done, then there's still this issue of where this capital is going to come from. Because the approach that you mentioned on focusing only on the top layer, on only on the managers which are going to back top 1% of the companies, this leaves out so many other managers, right? And what I'm trying to understand is if you can take a view outside of VenCap and try to explore on how this ecosystem can probably grow and deliver kind of better outcomes for LPs, if that makes sense.
Yeah, I'm not sure I share your view of the VC industry and what it should be trying to do, because I'm coming at it from an LP's perspective, and for me it's about how can we generate consistently strong performance. I'm not looking at it as a politician to say how can we use the venture industry to try and spur economic growth. One of the things we hear regularly from virtually all of our managers is that the venture industry does not suffer from a shortage of capital. It suffers from a shortage of world-class entrepreneurs. I don't know if you listened to the Jack Altman's podcast that came out with Keith Rabois at the weekend, but
Okay.
again he was saying this particular view that the gating factor for venture isn't capital, it's the quality of founders. And
Mhm.
so, I'm much less concerned about broadening the subset of sectors that are being funded, massively broadening access to capital for founders. I think venture works best when it's really hard to raise capital, when capital is scarce and time is plentiful, to quote Chris Duvos.
Yeah.
And I think that's what ultimately drives the best performance. So we've seen time and time again when the opposite is true, when capital is plentiful and time is scarce, that
Mhm.
we see way too many companies being formed, too many marginal businesses. Companies are capital inefficient. They spend too much money on things they shouldn't be spending it on. Entry valuations are way too high, and ultimately performance suffers. So, yes, we want to be funding dynamic businesses and fantastic entrepreneurs, but I do think there's a limit to how far that scales. And I come back to the fact that the vast majority of venture businesses don't work. It's interesting that the Carter have just released their data on fund performance, and one of the things they look at is the graduation rate from seed to Series A, and I think it was something like, I can't remember if it's 40% of companies don't graduate or only 40% of companies do, but it was one of the two. So
Yeah.
even there you're seeing the attrition rate between seed and Series A is exceptionally high. And there's probably another 60% of those companies that do successfully raise a Series A that ultimately aren't going to return the cash that's been invested in them. So I,
Okay.
I think I think the problem set that venture companies are addressing means that there is only going to be a handful of companies each year that are ultimately going to be incredibly successful. And so I don't necessarily accept that broadening the size of the industry is a good thing in the long term.
Got it. I agree actually to some degree to what you mentioned. And one of the themes that I'm trying to capture within the report, it says it should be harder to start a startup, but it should be easier to build a startup, right? So for example, a lot of people just start their startups. It's so much easier these days, and it should be much more difficult. Only, let's say, the top ideas, the top teams, and so on should kind of go forward and actually put a lot of efforts in building the startup. But with the
Mm.
help of AI, obviously, it's much easier and so on. It also might help, and I'm exploring this angle. It also might help in institutionalizing this asset class even more, because it might decrease the power law kind of figure within this ecosystem, because then you would have much more companies which are much more stronger right from the base, which are able to proceed to the next level.
Yeah, no, I think one of the challenges there though is that particularly at the very earliest stages, the ability to predict which companies in your portfolio are going to work and which aren't is really hard. At the pre-seed or seed stage, I think it's very, very difficult to have any real sense as to which of these companies are going to work, and which are going to fail. And in a way, what you want is to have plenty of experiments and let
Yeah.
the very best ones kind of bubble up, get to that Series A, and then that's when I think it's you can start to get a little bit more of a sense of predictability there. And again, when we look at our data, what we found, because most of the managers that we invest in, they'll do a little bit of seed, but they're predominantly Series A onwards. And what we find is that they actually do a really good job of layering capital into their best companies. So even though 40% of their, 60% of their companies fail to return capital, they probably only put 45% of the capital into those companies. And actually the 10% of companies that really work probably
Yeah.
get 15% of the capital. So they're able to efficiently allocate that follow-on capital as their degree of confidence in that business increases. But I wouldn't like to go and say, I love the idea of there being lots of experiments at the very early stage. So I'd almost take the other view to what you were saying, which is like, make it easy for people to start things, but they have to recognize that having the idea is the easy bit. Executing on the idea is the really, really challenging bit. And you've got to be willing to dedicate 10 years of your life, 7 days a week, 365 days a year in order to make that successful. And if you're not, then it's not going to happen. And even if you are, there's still a decent chance it's not going to happen.
Okay, awesome. So I capture your views on this specific topic later on in the report as well. Then, moving on, because you're short on time, I want to talk about secondaries, something that you mentioned earlier within the podcast that you've started to explore and you're going in this direction. There are a couple of other FOFs, fund of funds, who have started to build either partnership model or have been doing this out of their fund. How do you see yourself in comparison to or in competition to focused secondary funds, and what gives you the edge?
Yeah, so we've always done secondaries. So VenCap actually started as a secondaries firm. The first fund we raised back in 1989 was a secondaries fund. And just to be clear, by secondaries here, we're talking about buying interests in venture funds, so LP interests in venture funds. We're not talking about buying common stock in underlying companies. We only invest in venture funds. So we've always done it, but I think over the last kind of 10 or 15 years, we've been pretty opportunistic in terms of just reacting to stuff that was coming into us and not actively going out and trying to seek deal flow. We did feel a couple of years ago, as we saw the amount of capital coming into venture really skyrocket, it was very clear that a lot of LPs were coming in there with unrealistic expectations of the industry. And then the other side is what we've talked about venture funds taking so long to ultimately mature, that at some stage you've got to get out of that. And so, we've seen in private equity that there's a more robust market for end of life fund secondaries. And that was something that, we thought was probably going to become more commonplace and acceptable in the venture industry. So we brought a guy on at the start of last year, his job was to help us build out the deal flow pipeline and to institutionalize the analysis process, and also help us a little bit on the deal structuring side. I think, but it still comes back to our secondary strategy, still comes back to our core view of how the VC industry works, which it's about the top 1% companies. So for us, buying secondaries at a deep discount and not worrying about what's in the portfolio doesn't work. In private equity, buying things at a discount makes sense because it's a normal distribution of returns within a portfolio. In venture, the opposite is true. So we're really focusing on paying a fair price for funds where we think they contain top 1% assets, and making sure we optimize for quality, not discount. The very best secondary we've done in the last 15 years, which generated a 7 or 8x multiple, we actually bought at a premium to NAV. And they had one company that ultimately went public, and last time I looked was worth 40 or $50 billion. Okay. And so that's what drives the value in venture, whether it's primaries or secondaries. It's getting access to those. The question there is like, why would we be able to do that as opposed to, some of the big secondaries funds that have, huge amounts of capital? And I think there's a couple of reasons for that. One is that a lot of the best managers are very selective about who they want to have as LPs. And typically, they will not allow secondaries to be sold outside of their LP group. So as an existing investor in a number of those managers, we're already on the approved list of potential buyers there. So I think that, first of all, means that we're not, for a lot of our existing managers, we're not actually competing with those big secondary players because they wouldn't be acceptable investors into the fund. So that really narrows the field down quite considerably. Got it. And then the second thing, I think it was interesting. We've just done a secondary portfolio purchase in combination with a large secondaries player. And one of the things we found was our approach to valuing the portfolio was very different. So they took a normal distribution approach, which was like nothing. We don't think it was a mature portfolio, and their view was, okay, we don't think much of that's going to go to zero. We don't think much of it's going to do exceptionally well. There's going to be, most of the things are in that kind of fat middle. Okay. We took completely the opposite approach, which is we'll write off 70% of the companies in there and really focus in on the top 30%, because that's who we know are going to drive the value there. And we just had much better insight into those companies than they did, because we were investors in managers who backed those companies in other funds. And so I think that really gave us the ability to competitively price that portfolio based on a very clear understanding of the value drivers and what realistic expectations were for them. So I think in those competitive situations, we're probably going to, where we believe in the asset, we're probably going to lean in more aggressively than some of the big secondary players, because that's just not how their model works when they're looking at private equity. They want a broad, diversified portfolio where they're not dependent on a couple of companies to generate the return. So I think, we're happy with that risk as part of a portfolio. And so I think that gives us the ability to, to see things, to price them properly, and to be, to be really selective on where we lean in and where we don't.
Got it. So I think the key points that you mentioned is you're focused on doing secondaries from only the funds that you're invested in, if I'm right.
Yeah.
And
so we think
you have this insights into those specific assets or startups in this case, on how they're performing, what their growth looks like, and so on. You have some previous data to hinge upon, right?
Yeah. So it would be a mixture. So it would be secondaries in funds where we're an existing investor and we know the portfolio well, and we think we can price it efficiently, and we're excited about the potential. But then if we see funds where we're not an existing investor, but we know that they have one of those top 1% assets that is backed by one of the managers we back, then we can use that relationship with the manager to then help us understand what their view is on that particular company. And it gives us insight into where they think that's ultimately going to end up. So for secondaries, we then also, I guess, need to get comfortable with that specific manager as well. So for groups we're not invested with, there's an additional layer of manager risk that we need to factor into the equation and into our analysis. But I think predominantly we're looking for portfolios that have those key top 1% assets, and where we can take advantage of, hopefully some information arbitrage that we might have.
Got it. And so, from secondaries perspective, you mentioned that there has been obviously liquidity issues because of which secondaries have gained some fame within the ecosystem. How do you see it going forward? Let's say 3 years down the line. I mean, nobody has a crystal ball, but still, if you imagine a scenario in which the world looks brighter for the venture industry and everything is working up, let's say it's comparative to 2021 and 2022, do you still see the role of secondaries as important as it is right now? Do you still see this ecosystem of secondaries expanding quite a lot?
I think the way I would look at it is there's different cycles at play here. I think you've got a kind of long-term cycle where secondaries is becoming more acceptable in venture, and it looks more like what's happening in the private equity industry.
Yeah.
And so we would look at something that last year we probably saw about $9 billion worth of secondary deals,
Wow.
of which
Yeah.
about a quarter of those were relevant to us. That had a VenCap angle on them where we felt we would have some advantage in looking at them. Now, is that 9 billion going to get bigger or smaller? I think over the long term, it's going to get bigger, but I think it'll wax and wane depending on where we are in the cycle. So I think there's a shorter term cycle at play as well. And, when the liquidity markets dry up, venture's cyclical. We know that. We know there's going to be periods where the IPO window is wide open and we see huge amounts of liquidity. And so secondaries will become less important there. But we also know there'll be periods where it becomes really tight and secondaries become an important part of people's armory. So, we don't expect to see, a consistent level of secondary activity in the venture industry, vintage after vintage after vintage. But we do think the long-term trend is likely to continue to rise, whereby, it becomes a more acceptable part of the VC market.
Understandable. I want to move to a topic which would be probably very close to your heart. It's about explaining the risks to a first time LP. Let's say and there's an LP who wants to join VenCap and they are coming in for first time. I know this is unplausible because typically the first time LPs would probably might do it differently and so on. And maybe you don't even take first time LPs who are capturing venture asset class. But for a second, if you imagine and you have to explain the risk of FOF model, what those risks would be, how would you probably quantify them? And if they are not quantifiable, what would be the subjective nature of those risks?
Yeah, I think it's a great question because we do take first time LPs. We do spend time, educating investors about the venture industry, and we think that's an important, role for us to play. That's, one of the reasons why, we're active on LinkedIn and X and are putting these white papers out, because we do think there's a lot of bad takes that are out there about the VC industry because it's so different from pretty much every other asset class because of that power law nature. One of the things we kind of joke about internally is that if someone says, well, it's just common sense that this is the case in venture, normally that's a sign that they're wrong, because common sense and being right in venture are normally inversely correlated. Yeah. Because it's kind of, it's not intuitive. A lot of the power law nature of venture means that what you think will work ultimately doesn't. So I think for new LPs, the biggest thing we try and explain to them first is just really understand what the power law means for investing in venture. One of the things we see is particularly family offices that may have built their own business successfully. The first thing they'll do is invest directly into companies, and then they'll go into funds, and then they might come to a fund of funds. And actually for us, that's the opposite. It's absolutely the wrong way around, because they don't appreciate the fact that 60% of companies don't return cost. And the likelihood is of 6 out of the first 10 investments you're going to make are probably going to fail. And why is the world-class founder going to come to you as opposed to a Sequoia or an Andreessen or an Index or a Kleiner or an Axel or whoever? So there's adverse selection at play as well there. So I think for a lot of new investors in venture, it's really understanding how important it is to make sure you're able to access those very best companies. And look, if you've got an angle and you can invest in those companies directly and you've got the skill set to identify them and to get exposure to them, then you should definitely be doing that directly. If you can't, do it through a fund. And if you can't do it through the best funds, then come to somebody like us. But what you shouldn't do is compromise on quality. The worst thing you can do is to say, well, I can't get into the very best company or the very best fund, therefore I'm going to go to the next level down. Because what we find is that difference between the very best and the next level down in venture is just huge. And ultimately you'll end up with returns that are disappointing. So I think the key thing, first of all, is like understand the power law, understand like it's not optional investing in these top 1% companies. If you want your venture program to work, you have to get exposure to it. I think the second thing as well that I would say is it's very easy for new investors to be seduced by the narrative in venture. I still every manager that I meet, I walk out going, "That was unbelievable! Like I want to invest in them." Like their story is so powerful, and they've got some fantastic companies they can point to, and as individuals, they're incredibly impressive. They're top kind of 2 or 3% of the population, and you walk out going that was fantastic. But we know that the majority of those managers aren't going to be successful, that they're going to produce returns that are not worth having. Okay. So again, you have to be able to, what's the difference between a top 0.1% VC, a top 1% VC, and a top 10% VC? Because you need to be able to appreciate the difference. And I think for a lot of new investors, it's very difficult for them to do that. And it probably took me 20 years. And even then, it's still really hard. But I think it takes, and it's 20 years of meeting with the very best managers time and time and time again, so that you begin to develop that pattern recognition and understand like, why are these people successful? Why are they being selected by the very best founders? What gives this VC the right to give the very best founder capital and to share their journey? So I think it's really making sure that you're sort of focused on that and you build up that level of experience where, you can tell the difference between a good VC, a great VC, and an outstanding VC. And that's hard, and it takes time. And then, sorry, just the last thing on there, because I think it's a really interesting question. The last thing I'd say on there as well is don't let your ego get in the way. Because I see from a lot of VCs that, they're investing in a manager because they want to have a great relationship with them. They want to be able to pick up the phone and have a conversation with them on a weekly basis. We probably talk to our managers 2 or 3 times a year, unless there's something we absolutely need to talk to them about. Because, we recognize that their customers are founders. Their customers are the entrepreneurs. We're not their customers. We want to get out of their way as much as we possibly can. Yes, we've got a fiduciary responsibility to make sure we're doing what we need to do, and we'll make sure we do that. But we'll do it in a really efficient way, and then we'll get out of their way so that they can spend almost all of their time in economically productive activity, which is ultimately going to benefit the fund and benefit us as LPs.
Loved your answer. David. I want to ask, so maybe you can tell it, maybe you can share it. What's the difference, or let me ask it in a different way. What's the top question which a family office LP asks you and an institutional LP like a pension fund or insurance fund asks you? Like what's the difference between the kind of questions they ask you?
Yeah, I think family offices, for better or worse, they have a different decision-making framework and decision-making structure, and they can make decisions more quickly. And they might have very specific reasons for doing things. So I think when we're talking to pension funds, there's a much more drawn out framework there. And there's a whole range of exogenous factors that they also have to consider. We're spending time talking to a lot of the big pension funds in the UK. One of the things that they're really focused on is from an impact investment. How does this fit into our impact framework? It's very difficult to get startups to report on ESG factors. I mean, it's almost impossible. So how does that fit where you've got a pension fund saying, we need to know what the underlying CO generation is of our portfolio? Like, how do we fix that? There's no way of doing that within venture. The other thing that I think a lot of certainly the UK pension funds, they are limited to the level of fees that they can pay, and that looks through to the underlying managers as well. So they're actually optimizing for management fee rather than optimizing for the quality of the VC that they're backing. Wow. So I think I think there are some challenges, some structural challenges to certainly some parts of the big pension fund market investing in VC. We know quite a few of the big Australian superannuation funds, and they're really focused on what their management expense ratio is and their underlying portfolio, and their benchmark is a Vanguard tracker fund. That's at, I don't know,
ETF.
4 bips, 5 bips. So if you're a venture fund that's charging kind of 2 and 20, or even
Yeah.
for the best ones like 2 and 30,
I mean,
makes it pretty
it's like
challenging.
apple versus oranges, right? It's not even the same comparison. Got it.
Yeah,
Looking at the time, I want to cover this one last question, which is also very important. I want you to zoom out from the VenCap company, right? VenCap investment firm. And I want you to think about the emerging manager ecosystem, which is also getting a lot of, let's say, traction. There are a lot of managers there. And alongside them, there are a lot of LPs also coming in. LPs in
yeah.
different ways. Either they are FOFs, which are focusing on emerging managers, or they are dedicated programs within pension funds or LPs directly, or there are kind of other innovative methods like government focused funds doing investing in emerging managers. How do you see this ecosystem? What I'm trying to get at is, can you paint in the next 5 years the venture ecosystem with the same kind of one brush stroke, or do you see that kind of bifurcating into a couple of different directions, emerging managers versus established managers, and where do we go from here?
Yeah, so I think when I started doing this, like I think you could have a single brushstroke to cover the VC industry. It was pretty small, it was pretty concentrated, and it was all early stage, and yeah. But I think certainly for the last 20 years, I don't think it's true that there's just one thing called venture capital. I think there's distinct subparts of venture capital, and it feels like in more recent years those subsections are actually splitting themselves as well. Now we have pre-seed and seed, whereas previously we just had seed. And so and even on the growth side, we've got early growth and late growth and expansion, and so I do think there are very different segments of the VC industry. What we've found is that the very best managers are still able to play in multiple parts of multiple sections of that industry. Again, going back to we mentioned Wiz a couple of times, but like the seed investors in Wiz were Sequoia, Index, and Cyberstarts. So you've got two global platform firms that were the seed investor in the very best exit to have come out, or M&A to have come out of the venture industry ever. So to say that you have to have a specialist seed manager to do seed, well, it's clearly not true. That's not to say that specialist seed managers can't do seed very well. I think they can. And so as an LP, I think you have to, goes back to where we started. What is it that you're trying to achieve? Do you have a financial return goal that you're trying to hit here? Do you have a market indexing goal that you're trying to hit here? Do you want to specifically get exposures to sectors because you're a family office and you have a particular interest in those sectors? It complements your business. Are you a big corporate and that's investing for strategic reasons? I think there's. Are you a government sponsored organization? In the UK, we've got the British Business Bank. In Europe, there's the EIF. There's certainly a role for those type of firms to play as well within the ecosystem. So I think it's very much dependent on where you are as an LP and what you're trying to achieve and what your objectives are and how much risk tolerance you're willing to take, and whether you're happy capturing beta like we are, or whether you're shooting for alpha, which means you might there might be times that miss out. So I think it's a really dynamic asset class, and that
Do you
makes it
see it
interesting.
expanding? Sorry to interrupt, but do you see it expanding in multiple dimensions, like emerging manager, whatever that may be? But you see that expansion, right?
I think we've certainly seen an expansion over the last 7 or 8 years, but that's coincided with the top of the market. You look at the Carter data now. There's a lot of first-time funds that aren't going to be raising second funds. There's a lot of emerging managers that are struggling to raise. Last year, about 50% of all the LP dollars raised in the US came from just 10 managers. So there's a real concentration around proven performers. Whether you agree with that or not, that's clearly happening. So I think we probably saw the market expand too far too quickly in 2019, 2020, 21, 22, and we've now got a reversion to the mean, and we're probably going to overshoot in terms of going past that mean. We'll find an equilibrium point, and then the market will probably expand again. As I look forward, I do think technology continues to touch more parts of the economy. Again, when I started, it was semiconductors, a bit of networking, and a bit of biotech, and that was probably about it. A bit of software. Whereas now, you're seeing technology. Yeah, every company is a technology company. I mean, every company is an AI company, I guess, these days. So I think you're seeing the scope, the opportunity set for venture is getting broader. And then you're also seeing companies, rather than selling software to a company, you're now moving in and trying to own that particular market. You're trying to be the market leader in there. So you have the vertically integrated startups as well. That's capturing more of the economic value. So I think the size of the outcome and the percent of GDP that venture-backed companies are going to capture will continue to increase going forward. And I think that means the size of the very best companies will also increase going forward. So I do think we'll continue to see lots of experiments at the pre-seed and seed. And if you get into the right ones, you're going to do very well. But I also think there's going to continue to be a really interesting opportunity to be investing in slightly more mature companies where you have higher predictability and where the size of the outcome means that you can still get fund returning investments, even if you're investing at a Series B or a Series C.
David, with those insightful words, I would say thank you so much for joining in and sharing those nuances from a fund of fund perspective. So you have seen the ecosystem for such a long time that your insights are truly valuable. Thank you so much for joining in, David.
Right, I've really enjoyed it. Thanks very much for having me.